Good morning. Come on, good morning. Come on. Right. Was anybody here when I last spoke 6 years ago? Yes. 6 years and a day. October the 5th, 2005. I've still got the presentation. Title of the talk that day was Life After Debt. So don't tell me that us economists know nothing. Even then, we were beginning to think that there was rather too much debt for our own good. Little did we realise how it would blow up and what a disaster it would be. And the other thing we always said at that time was the longer this goes on, before it gets sorted, the worse it was going to be. And the problem is I don't think any of us could have imagined how bad it was going to be. 2005 was significant for, although a lot of the financial engineering, the CDOs, the alphabet super financial instrument creation still lay ahead of us. But in the UK it was significant because I think to a large extent it's 2005 when we started to lose the plot. An ill-judged interest rate cut by the Bank of England which inflated the household debt bubble still further. And it's also in 2005 that Gordon Brown decided that as he was in a position to not only set his own exam paper but mark the answers, well, he might as well mark them as he felt fit. In other words, it's in 2005 that he starts tarnishing and then breaking his own golden fiscal rule, without which we would have still run a very large deficit out of the recent recession, but a deficit of, say, 7% of GDP as opposed to 10 would have been rather easier to manage and left us not quite suffering quite the traumas that we are today. In those days, economic presentations were fairly jolly affairs, frankly. We'd turn up, we'd offer you a few prognoses. It was all fairly run-of-the-mill. We'd tell you a few jokes, hoping that you didn't remember that we told them you before, and off we go. Here we are, 4 years into the world's biggest financial crisis since at least the 1930s and possibly longer, and there is no end in sight. The advanced economies of the West once again teeter on the brink of a recession. The stakes are enormous. The race is on to find a credible solution to the Eurozone sovereign debt crisis before the situation becomes much worse and before the world potentially suffers another Lehman-type event, the outcome from which could range anything from a severe recession to a deep and prolonged depression. What we're now working towards is trying to get a solution of sorts in place by the time the G20 meet in Cannes on the 3rd to the 4th of November. And indeed, there is a meeting this afternoon in Berlin between some of the most important actors in this drama. The meeting will be attended by probably what are the two most important figures in sorting this out. Christine Lagarde, who runs the IMF, and Angela Merkel, Chancellor of Germany. And it's the interactions between the two of those and the decisions and directions that they will take that will largely sort out the direction in which we head and indeed whether we get there at all. It's not, I'm feeling a little bit more optimistic than I was a week or two ago, but I have to say it is not a done deal and it is not going to be easy. We start 4 years ago with the banking crisis. The banks are rescued, but the world has a major recession. That major recession and the act of rescuing the banks means that in the end we end up with a sovereign debt crisis. So the question now is a very simple one. If the sovereigns rescue the banks, who rescues the sovereigns? The answer is other sovereigns and the international community acting together. But can they be persuaded to do it? So not surprisingly, with the sovereigns in trouble and with the banks obviously lending money to the sovereigns, we now face the risk of more negative feedback and another banking crisis. You see the stress in the interbank markets. There are various indicators of this. This is one of the favourite ones, the LIBOR OIS overnight index swap spread. Don't worry too much about what they are. It'll probably take me 10 minutes to explain them to you, which will be half my allotted speaking slot, which is also incidentally why you shouldn't be following my slides because they're different. I didn't realise I had to do questions. So, the best thing that can be said about the LIBOR OIS spread, it is not as bad as it was in 2008. And it's also much worse than it is in Europe than it is in either the UK or the US, which is at least encouraging that the banking stresses have not spread so far to these shores. And indeed, we have learnt quite a lot since 2008. There are mechanisms in place to allow banks to get hold of liquidity that simply did not exist 3 or 4 years ago. But it's a clear indication that something is not right and that something needs to be done. So since May of this year, the Western recoveries have run out of steam. It's not just because of the debt crisis. It starts in February with the Arab Spring, which puts another $10 or $15 on the price of a barrel of oil, which makes the squeeze on the household incomes in the West still worse. You have households who find in the current labour market conditions that their earnings power is limited and their wages are growing slowly, gradually finding their disposable incomes eroded because inflation is growing faster than earnings. And recent oil price rises made that only worse, particularly here in the UK. Then we get the tsunamis in Japan which disrupt the global supply chains in the automotive and electronic sectors. And then from about the end of May, the debt crisis starts to bite. We always knew it could. I've said ever since it started, this needs to be sorted out credibly, otherwise it has the risk to spill over into the real economy. Until this May, it had not. We rescued Greece to the background of financial turmoil, but it didn't spread into the real economy. Likewise for Ireland last November. The rescue for Portugal in May was done without even a ripple in the financial markets. But the news that Greece would need a second rescue, at that point all hell breaks loose and it does start to infect the wider economy. So now we have a situation where in the second quarter, most of the world's major economies barely grew at all. America by 0.2%, the UK revised yesterday by 0.1%, Eurozone by 0.2%, Japan shrinks. Within the Eurozone, France 0, Germany 0.1. This is within the realms of statistical error that might even mean that some of these economies actually contracted. One of the big events turned out to be the first Friday in September, when we learnt that in August the American economy created a big fat 0 jobs in August. This is still one of the most keenly watched indicators. An American economy enjoying a healthy recovery ought to be creating 200 to 300,000 jobs a month, not a fat 0. That number will get revised, but it's still pretty poor. And it means the American economy is barely growing and it's certainly not creating jobs, which is the key political imperative given the number that they lost during the recession. So if you roll on from the second quarter and look at the third quarter, what happened in the third quarter, the best indication we have are the survey results that come from these various Purchasing Managers Index or PMI surveys. All you need to know about these is that anything over 50 means growth, anything less than 50 means contraction. We're now right on the button. The results for September were out yesterday. They're not in your packs, they should be on the screen if I've copied the slides over properly. The European number has gone negative, 49. Although, encouragingly, the UK and the US numbers were slightly better than August. They are still above 50. It means there is still a prospect that the UK and US economies will have put in some positive growth in the third quarter. It looks very unlikely that the Eurozone did anything much better than 0 in the third quarter. And all the forward indicators suggest things will be worse when we get to the fourth quarter. I'll say a little bit about Britain. amongst all this. We have, as I mentioned earlier, suffered one of the worst squeezes on household incomes because we've got one of the worst rates of inflation. Now, this is still completely bemusing and mystifying to the people at the MPC. There's still all sorts of academic inquiry going on as to why we copped more inflation than anybody else. And one of the reasons they thought was that actually we were underestimating our GDP and that there wasn't as much spare capacity in the economy as that suggested. Actually, yesterday, they didn't revise the GDP numbers up, they revised them down, so that's blown that argument out the water. So I think they're probably back to square one. And if they can't work out what's going on, then don't expect me to. Suffice to say, the squeeze on household incomes has been very severe. Which means that growth this year, even if we sort the debt crisis out in this economy, isn't going to be much more than about 1%. And even if we sort it out, it won't be much more than about 1% next year. The only hope is that if oil prices and commodity prices in general recede, that gap between earnings and inflation will narrow, and it's quite possible that by the third quarter of next year, about the time they open the Olympics, you might find consumers just beginning to get their heads above water and feel like spending again. Bear in mind that the money we've spent on the tickets actually gets counted in our GDP next year, not this year. So, the outlook for this economy is not great. 1% growth this year, 1% growth next year. That's assuming we sort the debt crisis out. And what we have to come to terms with is that this is a long, long job. Growth for the rest of this decade might well remain below what we'd expect as normal, which means that unemployment will be higher than we expect as normal. Consumer spending power won't be what we expected it to be. The ability and willingness of people to go and buy fancy food from Waitrose will not be quite what we expected it to be. Not to say that the middle classes are going to keep shopping in Aldi like they did for a short period after the 2008 crisis, and so they could talk about it to their friends. That's going to go on. But we're certainly going to be ever more conscious of what we're buying, how much we're paying for it. So, the one thing I think we can be fairly sure on is that interest rates in this country ain't going anywhere for quite a long time. The Americans have already decided that they're not moving theirs for 2 years. I suspect it will be about the same before we feel sufficiently confident that we can do the same. So I think you can be reasonably certain that base rates are going to be 0.5%. That's even if they don't cut them to a quarter. They're going to be 0.5% until sometime in 2013. The Europeans have the scope to do a few cuts, having done a few increases. They might even announce one today, although I suspect November is probably more likely. The only question from our MPC is will they do even more quantitative easing? When will they do it? If they don't do it today, it might well be November. And if they do it, how will they do it? This climate also makes predicting currencies even more difficult than usual. I tried not to do it even in normal times. I'm certainly not going to do it now. Suffice to say that despite all the volatility, the relationship between the dollar, the euro and sterling has actually been remarkably stable until the last few weeks. It's been remarkably stable, frankly, because the financial markets find it very difficult to distinguish between them. You know, it's a contest between some pretty ugly sisters, and they don't like the look of any of them. They're all backed by pretty sluggish economies that have got far too much debt. So how would you choose between them? And if the debt crisis were to be sorted out and the European economy start to recover, attention would again start to focus on the states where their situation is none too wholesome. Not least, you know, their politics aren't much better than Europe's. A complete impasse between the Republicans and the Democrats, which has laid the foundations for their downgrade and doesn't offer too much hope of decent political decisions being made there any time in the next 18 months. But at the moment, it's the euro under the cosh simply because of worries about whether this crisis can be sorted out. If it doesn't get sorted out, I think all you can say is it will probably fall a lot further. If it does get sorted out, it will probably recover. So the world, therefore, becomes ever more dependent on growth from the East. But don't think for 1 minute that they are immune. There's all this talk about decoupling, how the economies of the East no longer need the economies of the West. That's absolute nonsense. They need them less than they used to. And there's been a huge explosion of trade between the countries of the East. But they still need the West. And trouble for us means slower growth for them too. But they will become ever more important in pulling the global economy along, especially now that we're in the situation with the 4 BRIC economies, depending, of course, on how you measure these things, but in terms of purchasing parities, now account for a quarter of global output. They are slowing. Look at the same surveys as we've seen with Europe. These surveys don't compare the numbers between one to another. Just look at the lines. The lines come down. Most of these countries will have seen quite sharp manufacturing slowdowns. It's the services sector, the domestic consumption in these economies that is holding them up and keeping them growing. And of course, I don't think it's any surprise that if the global economy slows or worse, then we can say goodbye to the days of high commodity prices that we had until May this year. Prices of commodities will fall. They already are falling, especially for food and metals. Food is different. It's driven more by population than economic activity. So there will be some impact, but not as much as on the other commodities. Which brings me to the price of wheat. I'm not a grain analyst, but why should that stop me? Had a look at it just before I went on. Yeah, here we go, 140 something. Oh dear. Not long ago it was 200, wasn't it? I would make a couple of observations. Until last June, the price of wheat was pretty stable in the market in equilibrium at somewhere short of 100 a tonne. I personally, and I said this back in 2008 as well, I personally see no fundamental reason, barring supply shortages caused by weather events, speculation in the market, and export bans, why the price of wheat should sustain at over 150. I really don't see why it should do that. In other words, the price falls you've seen in recent weeks may well not be reversed. I don't see any reason for wheat to sustain at over 150 without significant weather effects. Right, Eurozone. What are we going to do about it? Anyone got any ideas? First thing to say is that the Eurozone, were it a proper union, as I think is now well established, would not need a debt crisis, would not have a debt crisis. If you shared out the debts right the way across the union, the burden of debt is less than in the States, a third of in Japan, and only a little bit bigger than ours. And its deficits, its annual budget deficit would be under half of ours, half of the States, and about half of Japan's. And it is the cruelest of ironies, mentioned by Osborne indeed in his speech on Monday, that Greece's budget deficit is no bigger last year it was no bigger than ours or America's, at 10-point-something% of GDP. It will be smaller than either of our deficits this year. And yet Greece is on the verge of massive default. Britain and America can go to the financial markets and borrow money more cheaply than any time since the end of the 19th century. And that is for the very simple reason that we have our own currencies, we have our own central banks, and they have their own printing presses. The markets now regard Italy as a bigger risk than Spain. And indeed, this is the nub, I think, of the crisis. Greece is manageable, it's not that big. There'll be a lot of toing and froing and shenanigans about how Greece gets a bigger default than the one that they sorted out in June, but a bigger default it will need. I think that is now accepted. Greece has a bigger default, you have to ring-fence the banking system. That, I think, is now accepted. It's therefore vital that they get this new EFSF thing revamped and sorted quickly so that it can do those jobs. But the bigger issue is preventing the contagion from really getting to Italy. You can build rescue mechanisms quite easily that can cope with Ireland, Portugal, Greece, with Spain, and doing some bank recapitalisation. Building one big enough to take care of Italy is quite a challenge. And if you want to frighten yourself every morning, all you need to do is get that little app, that little Bloomberg app that you can put on your iPhone. Under the markets section, click on bonds, and you'll see the 10-year bond yields in glorious Technicolor. Now, bear in mind that when these get much over 6 towards 7%, countries will find it very expensive to go and raise money in the markets and start to look to be rescued. I liken it thus. If the yields are under 5%, it's a bit like you're sitting at the top of a precipice, having a picnic, quite enjoying yourself, albeit you don't like the look of what you see when you look over the edge. At 5 to 6%, you're falling towards the edge and looking out for handy bushes and things to hold on to. Once they get to over 6%, you're in thin air. The good news is that the Spanish yield this morning is back down under 5%. The Italian yield is still at 5.4. It's not that comfortable, but there is a glimmer of hope. Why? Because in the wake of political consensus in Europe and among the politicians about how to sort this out and the time it takes to get anything agreed. I mean, this latest revamp was agreed in July and we're still working on it. The line has to be held by somebody, and that is the ECB. Since the start of August, the ECB has been in the market and bought up approximately 100 billion euros of Spanish and Italian debt, taken them out of the market, and therefore increased the price of the bonds and reduced the yield. And it's only thanks to the ECB that the yields are the right side of the abyss. How long will they do this for? How long can they do this for? How much stomach have they got to keep on doing this? I've no idea. That's a big imponderable. I certainly don't want to be doing it forever. It is a stopgap. It is the one and only lifeline that is keeping this crisis from becoming truly catastrophic. Indeed, today, at the policy announcements on interest rates at about 1:30, Jean-Claude Trichet, who I think is probably the hero in all this, will stand up and make his last statement as he hands over to Mario Draghi from November. But the guy in my book is tantamount to a hero, because without this, we'd be in all sorts of a mess. And it was done with opposition. There is not unanimity within the ECB about doing this, and the two senior Germans that opposed it have now taken their balls home and gone to play somewhere else. I think the other thing that's now becoming abundant but has not yet been agreed within Europe is that there is absolutely no point in keep on foisting onerous deficit reduction targets on the countries in the periphery. As we've seen from the Greek experience, all you do is make it harder for them to grow. The best way for anyone to pay their debts off is to expand their economy, preferably with a little bit of inflation as well, which is what we've been doing. We can't get proper growth, so we'll have a bit of inflation. Does the same thing. There really is no point in keep cracking the whip on these people. Part of what needs to happen in Europe, well, there's a couple of things that need to happen. One is a realisation that you cannot go back, that you can't unpick this thing. You might be suffering buyer's remorse, but it's like a piece of shoddy furniture you bought from a DIY shed 10 years ago. You now don't like the look of it. You can't take it apart other than if you break it. You can't go back. You have to go forward. You have to go forward to a fiscal union of sorts, probably involving issuance of common bonds and certainly involving some mechanisms for fiscal transfers. They won't be keen, but that is where they're going to have to go. And in the meantime, you've got to realise that the countries of the north also share some of the blame as to how we got here, and also enjoyed the benefits of a currency that would be much higher if they still had their own. Once those things have been fully appreciated, not only by the politicians, but by the voters, we might get ourselves in a better place in order to sort this out. So, like I said at the start, the stakes are high. The economic outlook is pretty grim if we do not sort this out. If we do, a gradual recovery might or should get underway next year if we can start to restore confidence. But still remember that even if we do sort this out, we still have a long way to go in order to work down the debt burdens of our governments and the debt burdens of our households. It is not a quick job. I'll leave you with an agricultural metaphor. It's also a biblical one. Mervyn King, in one of his speeches, likened it to the 7 fat years being followed by the 7 lean years. Well, frankly, if we get out of this with only 7 lean years, we will be doing extremely well. Thank you very much.